Good afternoon. Welcome to the Business Broadcast. My name's Nikki Larkin. Today I am talking to you regarding due diligence. So I'm going to go through two different sections. First of all, I'm going to go through why is due diligence required, what is due diligence, and who should be involved in due diligence. After that, when we've been through the whys, the whats, and the whos, we're going to go through three areas: the process, the outputs, and the risk. So hopefully by the end of today, you'll have more of a flavour of what is involved in due diligence, and you'll be able to make some effective decisions whether due diligence is required in a transaction and how much is required in it. Okay, so to start with, and also, as always, please do ask questions as we go along. I will answer any questions as we go live. If you're watching this on catch up, please do just DM me any questions if there's anything that I haven't covered that you've got a question on. And also do just say hi, because when I'm on my own, it's nice to see who is watching live as well. That's great. Okay, so first of all, why am I talking about due diligence? So I have been in finance departments and in accountancy practice for well over 25 years. And I've been a qualified accountant over 25 years, and I have been involved in hundreds of purchase and sales of businesses. A particular area that I often get involved in is the due diligence. So understanding what is required. So understanding various factors in the sale. So to start off, what is due diligence? So due diligence is when you're purchasing a business or you're purchasing certain assets from a business, it is very sensible to do due diligence. Now, regardless of whether you engage somebody to formally do due diligence or whether you're doing it yourself, you will be doing some sort of level of due diligence. And what it is making sure that what is being marketed is what you're buying. So that gives you some assurance to make sure that you're spending your money wisely in this purchase. So why is due diligence required? So it's so that you don't waste your money. I mean, there is a very high percentage of purchases that go wrong, either because a business doesn't know what they're buying, whether from a financial perspective, a commercial perspective, or culturally. And what due diligence does is hopefully finds out a lot more information about the business to prevent you making any mistakes, to make sure that you are buying what you think you're buying, and so that it gives you the opportunity that if what is being marketed is not what you're expecting, you can either disengage from the sale, so just say, sorry, it's not what I thought I was buying, thanks but no thanks, I'm walking away. Or alternatively, it gives you the opportunity to renegotiate terms, whether it's price, timeframes, or various other things within the purchase agreement. So that's briefly what and why. Thirdly, the who's involved in due diligence. So as I said at the top, it may be that you're experienced and you just decide, actually, I know what I'm doing. I know what I'm looking for, and I can do the due diligence myself. Now, for a small transaction and the risk might be low, you might think that's okay. However, in most transactions that we see, of course, are usually sort of SMEs or medium-sized businesses, that usually there are professionals involved. So from the buyer may they almost always will engage commercial lawyers, and then they also will probably engage For larger transactions, corporate finance team, or alternatively, financial advice through an accountant or tax advisor, or sometimes it's more of a sort of a commercially focused FD type person that does the FD for the smaller purchases. So you normally have a team of people, and they work together. They will look at, hopefully, they will look at commercial due diligence, legal due diligence, and financial due diligence. So I'm going to touch a little bit on all of them. Obviously, I'm a bit more focused on the financial due diligence because that's the area that I generally am engaged for. But I will probably touch a little bit on the other areas. So if anyone just does say, just don't forget to say hello in the comments, just so that I know that the LinkedIn broadcast is working properly. Okay, so first of all, the process. It will differ from different professional organisations, but if you're a new buyer, you've not purchased a business before, I'm going to go from the basics and go through what the purchase process would be from the due diligence perspective, so that you know what you should be thinking about to make sure that you get the best value out of your due diligence. So first of all, when you're engaging your lawyer, your corporate finance team, or your accountants, you should be agreeing what the scope of the due diligence is with that team. So what you're effectively doing is saying, because what you don't want to be doing is giving a blank check. So you will probably have specific areas that you're going to look at, and I will talk about the specific financial areas that are probably going to be on the table in a moment. But you will be discussing exactly what areas do you want these professionals to review. We'll be talking about your potential risk tolerance within the scope. We'll be talking about the timetable, what output that you require from them, and then hopefully you may be able to agree some sort of fixed fee with them. However, due diligence can become a bit of a blank check, because often when you're doing due diligence properly, then often things will crop up. So you want to make sure that you see everything properly. How we work with clients is we normally will scope out an initial fee, and then if there are any areas of concern where further due diligence is required, we would then request permission to widen the scope, and therefore of course the fees increase as well. Sometimes, however, it's just straight hourly rate, but you do see, even with lawyers and etc., you see more fixed fees. With corporate finance, often teams, it's often a percentage of the deal, and often they have some upside of how much they, particularly corporate finance teams, what they're wanting to look at is find where they can save money for you on the purchase price. So they often get some good upside on how they structure their deal. So it might be a percentage of the deal, and every million or £1,000 that they are able to negotiate below the original asking price, they'll get an enhanced percentage on that, so that they can really get a sort of reward type pay. So then what you do is, once those are agreed between the buyer and the professionals, the professionals talk to the sellers. Usually the seller normally has a team on their side. Sometimes you're dealing directly with the seller, but sometimes usually they've got their lawyers or their accountants that you're dealing with from their side. And then what you do is you would present the due diligence list of information that you require. in the best case scenario, you also will agree a timetable for when information is delivered and where information is reviewed, and potential meetings where information can be discussed and interrogated and questions can be asked for the other party. So that often nowadays the information is usually shared on some sort of online portal. It can be just something like SharePoint, Dropbox. Sometimes it's some other bespoke thing that somebody's got, and give access to a VPN to some client server. It depends how it's done. It's very rare now that you do that as a physical library. I remember the old days when you would have a literal due diligence library, and you'd have all the documents in binders and all stacked up. But now that generally is done online, which is much better from quality control, really. Also from searching, it can help in case you're not, you can actually search for things a lot quicker. So you've agreed that the timetable, you've agreed what's going to be within the due diligence library. The next stage, of course, is actually doing the due diligence. So the team, they need to be experienced people, because they need to be knowing what they're looking for. So just like with an auditor, you wouldn't go, you can't go to just anybody to have an audit. You have to have somebody that is experienced and knows what they're looking for. Exactly the same with due diligence. You need to know that they have been through transactions before. They are have a sensible process, and they are able to articulate any issues. The other thing on the output, now that does vary greatly between clients. So some clients would want, some buyers would want to just see some sort of output assurance report saying, right, we've reviewed these things, these are the risk areas, etc. Any notes of concern, any suggestions, etc. Others it's more of a ongoing process during, so they are alerted throughout the transaction, so that things, which is very sensible, because it's much better to be alerting people earlier, because if you come across something that is a deal breaker, it's much better to do that nearer the start of the transaction, because sometimes these transaction fees can cost, even with medium-sized firms, can end up being hundreds of thousands of pounds. For SMEs, it's usually more like in the tens of thousands usually, but you don't want to end up with huge fees for a broken transaction. So wherever possible, you want to know that any areas of concern or questions that have got going, it's much better to have that throughout the process. Therefore, by having regular report updates from your professional advisors, either in the form of update notes or regular meetings whilst you're going through the acquisition project. Now, if nothing is found, fantastic. Then everything goes ahead as per the heads of terms, and it's all great. And hopefully, the buyer then feels a lot more comfortable in their transaction. Where any areas of concern are found, generally you will go back to the seller, ask for additional information, so that there can be more comfort for the buyer that there are less issues, so that they can de-risk and be sure. If there is issues, then either they may want to put in additional warranties, or change the price, or various other different things that they may ask about. So there's various different things that can happen if there are any items cards, or it might be that they just say, well, actually that's just not material in this transaction, and they're not too worried. And as I've said before, if the issue is incredibly serious, let's say, say you were the person that was buying Patisserie Valerie and you did your due diligence and you found, actually, as per their accounts, there is a missing bank account, there is a load of money missing, for example. That's usually would sound warning bells, and you would probably, in that case, step away from that transaction. Now, as I said, I do recommend that you have regular update meetings between the buyer and your professionals, because it is much better to know about things as you go along. Also, a top tip in the process, really important that the different professionals do work together. So if they already know each other helps, but also that just making sure that they are working together, because there often is a lot of overlap in the analysis between the teams. So you don't want to find that the lawyers and the accountants or corporate finance people are chasing down the same information that they've already got in their library. So by sharing the information is very sensible. Sharing any findings that they have either side, often some legal finding, perhaps they're reviewing a lease for a building, may end up with a financial impact. So sharing findings between each other is very sensible. So I do always recommend doing it as a project team approach rather than independent professionals or working separately. Okay, good question coming from Guy. Let me just share. Aside from financial factors such as assets and liabilities, is it sensible to look at any other factors such as outstanding litigation or even something like bad social media coverage? Great question, Guy. I will go through sort of the three areas, what should normally be under them in a moment. And absolutely, due diligence is not just about the balance sheet. It encompasses lots of different areas if you're doing it properly. And so indeed, anyone that's worth a salt in due diligence would cover there in the legal section. There's always a section asking to declare any ongoing or even any litigation that has happened in the last certain amount of years, however much they're asking for you to declare. A very good point on this is if you have asked at something within your due diligence, so for example litigation, and the other side has not declared that they've got some sort of ongoing case, that can then become they can have financial penalty if the transaction happens, and then of course when you start running the company you find that there is some ongoing litigation, and that hasn't been declared in the due diligence, then that should be able to be clawed back in some way, depending on what clause you've got in your SPA, and you should be able to have some, either whether it's financial penalty, legal, however you want to do, whatever remedy you decide is appropriate. But yes, indeed, in increasingly social media is important, and that's, you can see that so clear. So a good review of what's going on. So in the commercial section, it's very sensible to have a look at that. So I just wanted to go through the areas from the financial due diligence, because like Guy said there, he said about assets and liabilities. That's not the only thing. Even with just in the financial due diligence section, it's much more involved than just looking at the balance sheet. So I'm looking now at a financial due diligence list, just a basic one for an SME. It's got about 30 areas in, 30 summary sub areas that I would expect to have and then kept in the library and reviewed. So I'm just going to go through the headline areas. So because we've only got 10 minutes more, so there's certainly not time. I could take a whole day on going through how due diligence works. But the areas here we've got are balance sheet reconciliations. So making sure that the areas on there is ensuring that the balance sheet is correct. So whether it's looking at the fixed asset register, so reviewing actually what are the fixed assets compared to, whether it's a physical review, doing stock counts, those sorts of things. Checking, so various different methods, usual sorts of checks that you would have in an audit. So if a company has been audited, that helps with your level of assurity and de-risks it somewhat. However, you should still do some sort of checks as well, especially if the information is still quite out of date. Profit and loss review. I particularly think it's important having profit and loss reviews and also stress testing it. So it's what are the things that could impact it. Especially now at the moment, you've got the risk of what happens if you have to increase all your staff costs by 10%, or what happens if other inputs, your materials costs go up by 20% or 50%. It's stress testing what happens then, how much flexibility have you got with your contracts in your P&L to pass those costs on, or are you tied into contracts to deliver where you've got your costs being stuck? So having some real good stress testing really helps. Thirdly, a sales review. It's always really important to look at the details sort of by month, so you can see if there's certain cycles through the year. You might find that actually the business, perhaps they do 80% of their sales in December. So, if you go and close and get the business in January, you're waiting an awful long time before you start getting those sales through again. Looking at analysis by client, so that you want to see, is there any risk, or as in, are there clients in there that are at risk? Have they got ties to the management that may be exiting the business? Is there a high risk, as in, is there one particular client that has majority of the revenue? You want to look at, you don't, it's very worrying if you find that actually 20% of the revenue is from one particular client, and you fall out with them, that's all your profit gone. So you do need to have a thorough review of that, and also your sales by product analysis, looking at, are there products or services that they're providing that aren't actually making money? That's a really good area. That is a very big value added area that you can be giving to your client, the buyer, because when they take over the business, they may find that actually when they take it over, they will restructure in some different ways and focus on the areas that are more profitable than others. The next is the supplier review. So very similar in some ways to the sales review, looking at the cost by month, looking at the supplier analysis, how many different suppliers have you got, checking against supplier statements, making sure that actually are the books up to date, or are there a load of costs on somebody else's balance sheet that you're not actually seeing at the moment. So doing some checks there. Also doing tax compliance review. So it's from the very basics, as in, are they up to date in all their taxes? Are there any risks? Are there any, have they done any high risk tax planning areas that you need to look at and see, are they at risk? Have they had some sort of loan charge scheme or film tax? Well, that wouldn't be film tax, but like any various other different things that could come in there. Are they some sort of options in there that might be risky? Just looking at any other types of things in there that are risks in there. Are they, they got transfer pricing risks, for example. Next one, which is my favorite area, because this is the bit that I spend a lot of my time on, is producing forecast models, is analysis of the forecast review. So looking at the business model that they're presenting, because it's all very well looking historical. What you're buying is the future. So you need to look at what are they looking at producing over the next 5 years. You'd usually hopefully make sure that you get your money back within those 3 to 5 years. So it's really critical. And so by looking at those models, looking at stress testing again there, seeing if there's any issues, any risks, are they being wildly optimistic in their models, or are they very conservative? Are they somewhere in between? And looking there. And then finally, in the financial area is the financial commitments. So it's looking at the staff analysis, property leases, loans. So all the things that you are tied into, to make sure that even if you did some sort of restructure, that you need to understand what costs are you still stuck with. So especially if you are buying a business to merge into other businesses, and so you were thinking, right, I'm buying this business because I want to increase my market share, but I want to get economies of scale by using my staff in other areas, etc. You need to look at what actually, is that going to be something that you can straight away get, or are you going to have a big cost, first of all, to exit out of leases and to make staff redundant, etc. Then the other two areas are the legal areas. Now, they will be looking at all the paperwork. So they will be looking at HR, they will be looking at any, they will look at staff contracts, contractor contracts, main supplier agreements, main customer agreements, making sure that there is a lot of stickiness there, making sure that there's not any terms and things that are detrimental and worrying that that the lawyers would want to raise, and they would go through all of those extremely clearly. They would be looking at, has there been any type of litigation, whether it is from clients, whether they've had any client complaints or litigation. Are there any, are suppliers unhappy? Are there any counter to court judgments out there? Anything like that? And then also with employees, making sure, are there any outstanding actions there? Are there at risk of any type of litigation there? A few other things that Guy has mentioned, and that does come into, so one aspect of seeing miss and pass is the buyer failing to look at the staff turnover of the firm it's buying. Now, I luckily haven't seen an issue with that, because normally when I've been involved in transactions, the lawyers, or indeed the financial people, have looked at number of staff per year, length of service, looked at the history, and so that would be apparent if there is a high turnover of staff, because what you want to make sure is that the staff that you're wanting to keep are sticky, and that they're good staff, and if there are concerns. So he's obviously been in a transaction where that wasn't a road, because whoever was buying didn't look into that detailed enough. The very common, guys on a roll today, whether the outstanding debts are collectible or hiding irrecoverable amounts. That's also very common. Looking at, debtors analysis is generally always if there's any long-term debts. Also, similarly, if there's a lot of work in progress, how much of that is real, or how much of it can potentially go away. Interesting one that he's put as well is about gender pay issues. Now, you would hope that there isn't any issues in there, but again, that's usually through some general, quite easy analysis. If you've got people at similar levels, grading levels, if you're buying company that has got grading levels, they have proper structures in their pay, etc., you're less likely to have those sorts of issues. But if they haven't got those sorts of processes, because that's again what the lawyers are often looking at, is their processes and procedures and things. And from the commercial review, you would have a look at that. So just finally, risk. So from the outset, always assess what risk are you willing to live with. So when you're buying a business, absolutely essential to have your client's business plan and your business plan, and see therefore what your tolerance levels are. So if you think that actually this purchase wouldn't work, for example, if the sales dip by 10%, then you need to know your risk tolerances. Similarly, if looking at, I've seen sometimes in due diligence, you know, and I've worked with some, you know, top-notch people in this area, and often it's, you know, really good and they do know what they're doing. Sometimes though, I have been astounded when you've seen people, you know, corporate finance people or lawyers focusing on minutiae, which has absolutely no materiality, and you're thinking, why are you spending time asking a question on, I don't know, so £250 cost when they're charging £400 an hour? It makes no sense. So do make sure as the buyer that you're very clear on your materiality, what you're looking for, what your tolerances are, because, you know, you do have to weigh up what is the risk of this transaction if it goes wrong. Is it going to be just, okay, I've spent £1 million on this and it goes wrong, but there's potentially legal risks in there that could be 5 million, 10 million pounds. You know, that is a big risk. If, however, you know, there's risks in there that you're talking 10 grand here or 10 grand there, that's not necessarily going to be such a big risk. So you do need to be very clear with your risk and your scope to make sure that you are balancing the due diligence analysis sensibly, so you're getting the best out of it for that particular transaction size. So, you know, you don't want to be spending £100,000 on a transaction if you're only paying 200 grand for the purchase. You know, you need to get the right balance there. Of course, I absolutely think it's very important to do thorough due diligence, but do make sure you balance that all the way through. So the top tips are: 1, get your risk profile right. Make sure you understand your materiality, and be careful on how much you're paying there. Second, make sure that all of your professionals are working as a team, because you don't want to be paying for the same analysis from 2 different areas. So make sure you've got the team. And thirdly, make sure you've got regular communication with your due diligence team, so that if there are any risk areas, you know about them as soon as possible. So that's first, understanding your risk and materiality. Second, making sure your due diligence team works as a team. And thirdly, the communication, making sure it is on time and as early as possible, not even on time, as early as possible, so that you don't waste your money. Because, you know, a transaction always takes your time, not only your money of actually paying for it, it takes your time, and you don't want to waste time and effort on something which is not right if that some early warning comes out in the due diligence early on. Okay, I hope that was useful for you. Thank you very, very much for watching. Any questions that you do have as follow-up, please do contact me on LinkedIn. I'm on there as Nikki Goringe Larkin, under Goringe Accountants and under Succession Planning Business as well. And be delighted to help you. Next week, we are taking a slightly different tack. We're looking at we're looking more at if you're the seller, actually. So today we've been talking more if you're the buyer. Next week we're talking about your seller, if you're a seller, and the tax things that you need to particularly be aware of. And we will be talking to our tax expert, Richard Feekins, who will be talking about the tax planning and efficiency that you can do. Thank you very much. Have a lovely weekend and cheerio.